Uh, Hi, good afternoon, everyone. My name is Rishi Jhunjhunwala. I've been a research analyst for 15 years and currently I cover the insurance and technology sector as a lead analyst at IIFL Institutional Equities. Today, we are going to discuss the impact of the COVID-19 pandemic on the insurance sector. And would this sector be one of the leaders as the markets and economies revive in the medium to long term? So if we look at, if you look at the insurance sector, we can split it into two sub-segments. One is the life insurance and the other one is general insurance. And both of them are completely different in terms of, the drivers of earnings and how the sector behaves. So let's discuss both of them separately. First, on the life insurance sector, there are two parts to it. One is the savings segment, wherein any policyholder would go on and invest in a ULIP or in a participating or a non-participating policy. Those are typically done with an objective of savings with some bit of life cover attached to it. So those are in a way an investment vehicle rather than something to protect your life as such. The second segment is the protection segment, where you actually take a term protection policy to cover your life. So the difference between the two is, the amount of coverage that you typically get in protection versus in savings. And there are different implications in the near term on both these segments in the life insurance sector uh, because of the COVID and also from a long-term perspective. So if you look at the COVID implications, basically what has happened is that the country is in lockdown mode for the past 2 months and more. And what that has resulted in is drying up of insurance premium sales, primarily because insurance is a business that is done in person. A lot of the business gets written once in person, and because of the lockdown, that was not possible. And so there has been, a complete standstill in terms of premium growth for insurance companies. And right now, I'm just talking about the life insurance names. So one, new business has come at standstill. Second, even on renewals, there has been risks in terms of how the premium growth is happening. And that's primarily because, for renewals also, the overall business has to be done. Not everything is online, and as a result, not all renewals happen online. But it is still, the impact on renewals is much lower than that on the new business side. So that's where things are from a premium growth perspective in the near term. And that's where you've seen the industry witnessing 30 to 40% decline in premiums in the near term. This is, of course, much lower than what we would have initially anticipated, considering the entire country was in lockdown and you could have actually had 80 to 90% decline. But this also represents that the companies are now far more adept to basically sell insurance premiums online and through offline channels rather than having a physical presence as well. So in the near term, the stocks also saw similar kind of corrections. But if we really look at the life insurance sector from a slightly medium term perspective, and once the lockdown gets over, what you're going to observe is that there will be a smart recovery in the premium growth. That's primarily because insurance is one sector which is not directly impacted by COVID, right? I mean, there are sectors like travel, hospitality, restaurant, airlines. All of those are directly impacted by the COVID lockdown, but insurance is impacted purely because you can't go and sell it out to a third party, but not because the demand has actually gone down. So that's where things are in terms of the business growth. So as soon as lockdown gets over, things start becoming normal. You should see a smart recovery in the premium growth on the life insurance sector. If you really look at from a long-term perspective, there are secular drivers which basically contribute to the growth, and that's where insurance is one of the sectors which will potentially grow at a pretty fast rate, 15 to 20% over the next 10 years. So very few sectors are left in India where we can give that kind of a visibility, primarily because there is a significant underpenetration. So even though LIC has been selling policies for the past 50, 60, 70 years, but if you really look at it from a real term protection perspective, the country is significantly underpenetrated. And by that, I mean that, for every 100 rupees of insurance cover that one person needs, probably the average cover is only 10 rupees. So there is a 90% gap between how much risk assurance needs to be there versus how much it actually is. And that is something which will drive growth for India in the insurance space for the next 10-15 years. So that's where there is a clear cyclical story, in terms of how the insurance sector could continue to grow. Within that, as I said, savings or investment related products will continue to grow in line with nominal GDP. So, we could expect anywhere between 12 to 13% kind of growth over the next 10 years. Protection, or, the term life policies that you and I take, that is something which could grow on a consistent basis at 25 to 30% for the next 10 years or so. So on a blended basis, what you will see is this industry growing at 15 to 20% pretty easily for the next 10 years. And that's the kind of growth visibility that you see in life insurance. And, one of the things that catalyzes the growth in protection is events like these. As COVID has spread its outbreak, we have actually seen the demand for protection products go up significantly. The awareness has increased, and as a result, you will see significant growth coming in the protection side as well. So as an industry, life insurance industry will continue to grow at 15 to 20% from a 10-year point of view. Of course, there will be cyclicality because the savings business is directly linked to how the capital markets behave. But on an overall perspective, if you take a long-term view, there is significant growth that can be captured. Within this life insurance sector, if I talk about some of the companies that are listed, and of course the largest player is LIC, which is almost 2/3 of the market share, but it is not a listed company. Probably will get listed sometime in near future. The government has shown its intention to do that. But if we really look at the private players which are listed, the three largest players are SBI Life, ICICI Prudential Life, and HDFC Life. All three companies are, they started operations 20 years ago, have been backed by their bank promoters. So SBI Life is owned by State Bank, IIFL Life is owned by ICICI Bank, and HDFC Life is owned by HDFC Limited and has HDFC Bank as a sister concern. So, because of that kind of a platform that they had, they've been able to grow at a much faster rate and gain scale at a much faster rate compared to the other players. So there are almost 22 players operating in the life insurance sector. But these three players, along with LIC, would be almost more than 80% of the industry. So that's where there is a big gap between some of these private players which are listed and the others which are not. And that's where the most of the value creation will potentially happen over the next 5-10 years also. So if you look at these three companies, in case of HDFC Life, they started late within these three players. But of course, just like the other group companies like HDFC Bank and HDFC, they have historically been leaders in terms of product innovation and technology. They have identified new growth opportunities much early, and as a result have been first movers and have gotten the benefit of that in the long term. That's where from a growth, from a margin, from a profitability perspective, HDFC Life comes at the top. But that is something which is reflected in their valuations as well, and that's where it is the most expensive stock in the coverage. The second one is ICICI Pru Life. It has historically been, they have driven their business through ULIPs or unit-linked products, and that continues to be a big growth driver for them. Almost more than 70% of the business comes from there. There is, both pros and cons attached to having only ULIPs as a big portion of your overall business. Because in bad capital markets, the customers actually pull money out of ULIPs, and that's where the growth collapses. But in good capital markets, exactly the other, things happen the other way around. So that's where IPRU Life is, has a growth profile which is a bit more skewed or a bit more volatile compared to the other players. But they are very strong on retail protection. They are probably one of the largest players in retail protection, and that is something which is driving growth and profitability for them. If we look at SBI Life, that is something which comes as a proxy to LIC, right? So one of the reasons why people buy insurance from LIC is primarily because one, the reach, you'll find an LIC agent in every nook and corner of the country, and secondly, there is a trust factor attached with LIC that if money has gone to LIC, it will come back. And of course, it is backed by sovereign guarantee. So the government ensures that there are no defaults on payments to the policy holders. And that's the reason why, despite being a PSU, LIC has been able to capture and maintain a significant market share, even if private companies have been in the business for past 20 years. That's not the case in most of the other, industry like, banking or some of the other industries like telecom as well. But in insurance, that is true. So from that perspective, SBI Life is considered to be a proxy to LIC. There is a similar kind of comfort, especially among the mass market customers, the middle income group, the tier 3, tier 4 city people who actually, think SBI as, have a similar comfort level as LIC. And of course, because of increased data proliferation, people can see and compare products and pricing, and as a result, there is market share gain towards SBI Life. So SBI Life basically is a disproportionate beneficiary of market share loss to LIC, if at all. So it doesn't compete with IPRU or HDFC in a big way. It competes with actually LIC in a bigger way. And that's where I think the value of SBI Life will be driven. So IPRU and HDFC in a similar bracket, but similar product, but different product segments. SBI Life in a different customer segment and a franchise, on distribution, which is unparalleled compared to most of the other banks. So that's where these three companies, all three are, great investments to be made if you have a long-term view. Of course, in the near term, there will always be a factor of valuations. One is more expensive than the other, and that's where sometimes that's where sometimes there are issues. But otherwise, from a long-term perspective, I think there is clear value to be made in any of these investments. So that's where the life insurance sector is, and once things normalize, you will see people starting to invest a lot more back in insurance, life insurance products. There are benefits of investing in life insurance products, primarily because there is a tax arbitrage. It is the only financial investment where long-term capital gain tax are not there. Even equity mutual funds are taxed now unless they are ELSS. And you have an option of having asset allocation in terms of having between debt and equity. So I think that's where things are in terms of life insurance. If I just try and move back to general insurance, and that's where it is related to basically non-life sectors. So there are insurance segments in the form of health, in the form of autos, property and casualty. So general insurance is a sector where there is no savings element, right? So you are covering some of your assets, whether it be you yourself in terms of health, or whether it be your car, your property, and all that. So I think that's where the non-life insurance it operates. It is also from a COVID impact perspective, again, non-life insurance sector is something which is relatively less impacted or significantly insulated from some of the macro shocks that we are seeing, right? So, for example, you have to renew your car insurance. You can't do anything about it. It's mandatory. You will probably have to, insure or renew your health insurance. Otherwise, it will be a big risk in the current times. As a result, it's something which is utility in nature and necessity in nature. and should not be significantly impacted from the macro shocks. In fact, in segments like health insurance, you will actually see much higher demand now, considering how the pandemic has panned out. So one, from a premium growth perspective, the impact will be far lesser on non-life insurance compared to any other sector in the country. And second, also, the losses for the companies will be far lower if there are no cars, plying around in the lockdown, or there is a significant reduction, then the number of accidents will also be lower. And as a result, the profitability for the life insurance companies will also go up. So there is a perfect hedge in terms of how the life insurance sector, the non-life insurance sector actually is positioned in the overall scheme of things. So, on non-life, again, relatively insulated from a long-term perspective. There is significant underpenetration. If you really look at it, the only thing mandatory in non-life sector is car insurance, and that too, motor third party, not even motor OD. In fact, penetration in car insurance is less than 50% after the first year and less than 30% after the third year, even though it is mandatory from the government to take car insurance. So that's the kind of underpenetration that we have in this country. On health segment, there is only 7 to 8% of the people are actually insured from a health insurance perspective. So again, significant scope for that number to go up. And when you start comparing it with some of the global markets, some of the emerging market and Asian peers, you'll find India to be significantly underpenetrated. So again, same story. Long term could continue to grow at 15 to 20%. So there is a clear runway of growth, and that is where the general insurance industry is also, much better positioned compared to some of the, other sectors that you see. So, even on general insurance or non-life insurance, basically, as things normalize, you will see premium growths starting to grow again. And that is something which will drive premium and profitability for these companies. Probably they will be the leaders, right? So because they are not necessarily impacted as much from the macro shock or not directly hurt by the COVID, as things normalize, they will be one of the first, sectors to actually come out of it and start growing back at 20 to 25%, the kind of trajectory that we have seen over the past 3 to 4 years. If you look at, players in the non-life insurance industry, from a listed space perspective, there are very few, which is quite unfortunate. But hopefully we'll have a lot more companies listed over the next 3 to 5 years. The one pure play company on the private space which is listed is ICICI Lombard. The largest private player, one of the most efficient ones, has great, scale, distribution, investment leverage, and as a result is disproportionate beneficiary of some of the market share gains that are happening in this industry towards the private side. There is a government or PSU company, New India, which is also listed. There are 4 PSUs which operate in the general life insurance insurance industry, but only one is listed, which is New India. But that's the most efficient one. The other 3 are a lot less profit making compared to New India. So it's a best in class within the PSU, but still doesn't stand close to some of the private players from a profitability and efficiency perspective. And that's where the valuation differential between, say, an ICICI Lombard and a New India would be. So if you really are looking at investing in the general insurance industry, ICICI Lombard is probably the only clean way of playing it. If you have a near-term horizon, then of course, stock has done reasonably well despite correcting significantly in March. There has been a sharp recovery, and as a result, valuations have become a bit expensive. If you have a 2 to 3 year view, you can buy it at most of these levels. Any correction should be a buying opportunity, and it will still give you much better returns than the broader market. That's what our view is. Of course, in the near term, probably the upside is limited considering most of the recovery has already happened. So that's where things are, right? So if you effectively look at it, the clean ways of investing in the insurance industry, whether it be life or non-life, are SBI Life, iPru Life, HDFC Life, and probably Max Life on the life insurance space, and ICICI Lombard on the general insurance space. There is Bajaj Finserv also, which has insurance businesses, but it has a big component coming from Bajaj Finance, which is an NBFC, and that's where I'm not focusing on that at this point of time. So bottom line, what you're going to see for insurance industry in the near term, it has seen, the sector has corrected by, 20-22% year to date. It is pricing in most of the decline that would have happened as a result of COVID-19. The premium declines have actually been lower than initially expected, and hence there could possibly be some bit of upside risk in terms of how premium growth and overall profitability plays out for these companies from a 12-month perspective. And of course, there is a long-term structural story. The sector could continue to grow 15 to 20% over a 10-year period, and hence these are, great, stocks to have in your portfolio. And you pick any of them. Our preference on general, of course, is ICICI Lombard. On life insurance is SBI Life, and then IPRU and HDFC. But in the long term, I don't think there should be too much of a difference between any of them. So with that, I wrap up my initial comments, and I can take questions. I request you all to please put your questions in the Q&A box and not in the chat box. And I'll pick some of them. I already have a few questions which some of the attendees had actually sent. So probably I'll address them first, and then I can take up some of the questions which are put on the Q&A window after that. Hopefully we'll be able to address most of them. So some of the questions that we received beforehand, there is one Mr. Deepak Goyal who said, if somebody wants to invest for long-term perspective, where to invest? As I mentioned, both life and non-life are great investment opportunities or sectors to do that. Probably, non-life a bit more than life, but if you have a 5-year view, insurance is one of the industries that you should definitely invest in, and these are probably good times to invest in because there is concern on growth and valuations have corrected. Second question is from one Mr. Ankit Bajaj. He asks if HDFC Life is better placed than IPRU. So if you really look at, from business fundamentals, and if we compare both the companies from a, profitability and growth trajectory perspective, of course, HDFC Life has done much better than IPRU in the recent times. One of the reasons is, of course, as I explained earlier, that IPRU is far more skewed towards ULIP's business, which is prone to volatility because of how capital markets behave, whereas HDFC Life has a far more diversified portfolio of products. And that's why from a product positioning perspective, from a profitability perspective, HDFC Life is better than IPRU at this point of time. But you have to keep in mind that that is something which is a known fact and which is reflected in the valuations as well. So that's where HDFC Life trades at almost 80 to 100% premium to IPRU from a valuation perspective. And so there is not too much of a difference. A lot of these superiority in growth profile is actually priced in the valuations for HDFC Life as well. In the near term, probably IPRU Life can give you slightly better returns, primarily because the valuations are depressed and they got significantly impacted from the capital market decline. But, over a medium term, probably HDFC Life might still end up giving better returns considering their diversified product portfolio. The next question is from Mr. Naresh. He asks if the insurance sector is likely to suffer from clauses such as loss of profit, loss of business of celebrity endorsements, loss of non-performance of sports events, or some of the cyclones and all those things that we are witnessing. So this is, I think, something which is related to general insurance and not to life insurance. In India, there are, unlike in developed markets, typically the property damage insurance does not cover clauses around loss of profits. So if a mall has been shut down because there is a force majeure clause around, government asking them to shut down, it is not the responsibility of the insurers to compensate them for the loss of profit. The insurance companies are can compensate only if there is a property damage. And that is where the property and casualty segment of the general insurance sector is so significantly underpenetrated. If you are in UK or in US, today the insurance companies would have to pay up for loss of profit as well. So I think that's another big opportunity for these insurance companies to tap into. And that's another big, area where, businesses, MSMEs are going to take, insurance policies and cover some of these clauses as well, which is again, is going to be one of the growth drivers in future. But today there is hardly any impact on these insurance companies from some of these business casualties. Of course, there are some insurances that are taken around some of the sports events, like in Cricket World Cup, there were some India matches were insured from rain washouts and all that, but that is very small portion of the overall insurance business that these companies do, and as a result, there won't be too much of an impact. Whether the current cyclone that is happening in Orissa and West Bengal is going to impact some of these insurance companies, probably. But if you look at historically, only 10% of the economic losses done by some of these natural catastrophes like floods and cyclones get covered or are actually insured by the insurance sector. So again, that reaffirms the point that insurance penetration in India is significantly low. So for the same reason, the impact on some of these insurance companies will be limited. The next question is from Deepal Shah, asking for choosing between life or general insurance for long term. As I said, both of them are have structural growth stories around them, and so they are good areas to invest in. If I still have to probably pick one among some of these, I can still pick general insurance. Probably the underpenetration levels there are much lower. The regulations are not as advanced, and the scope for making money is higher. But the restriction is that there are not too many stocks which are listed there, and the only pure play, as I mentioned, is ICICI Lombard, which at current valuations probably is slightly expensive from a near-term perspective. The next question is from Mr. Vishal Fatesaria. So he says, he asks, what is the view on HDFC Life? So I think, as I've told you that, HDFC Life is one of the most well-run insurance companies, has a product portfolio which is significantly diversified, has been leaders in product innovation, identifying growth areas, and as a result is first mover in most of the areas. And that's where their profitability also is much better compared to the other two. But that is to a large extent reflected in valuations as well. So I would from an investment perspective, probably in the near term, there is not much upside in HDFC Life compared to some of the other names. But considering the kind of track record that they have over the past 5 years, I would still bet on that from a long-term perspective. Next question is from Nilesh Savant. He asks, would like to know which is better bet for long-term 10-year perspective between life insurance, general insurance, standalone health insurance, or reinsurance companies. There are no standalone health insurance companies listed. Unfortunately, there are 6 players which are pure specialists in health insurance, but none of them are listed. So there's not much choice in there. On reinsurance side, there is only GIC Re, which is listed. And that is kind of a monopolistic business. I mean, I think they have 60 to 70% of the market share in India. So from that perspective, ideally, it's a great business to own. But of course, reinsurance companies are the one who actually take the complete hit of the catastrophes or some of the big damages that happen, because the life insurers or the general insurance companies basically pass on some of those risks to reinsurers. And that's where the earnings profile for reinsurers are far more volatile compared to the primary insurers like life in general. And that's where, you have to take a call on valuations. Probably, GIC Re from a long-term perspective still is a good story to own. but it is not for the faint-hearted, right? I mean, there could be significant volatility in earnings in any particular year, and that's something that you have to be cognizant about. So as a retail investor, I'll probably not recommend looking at GIC when you have options to own some of the other names on the life insurance and the general insurance space. Um, and then the last, question and there are multiple questions around this in terms of which stocks to pick and whether these are multi-baggers in the long term. I think I've addressed that, multiple times in terms of how the, the insurance industry has long runway for growth, and that is something which will drive returns. So it's a great sector to invest in from a long-term perspective. If you really look at insurance in India, we are still at the tip of the iceberg from a listing perspective. Imagine LIC, which is 60%, 70% of the market getting listed, the amount or the kind of market cap that it could command and the interest that it could get. If you look at globally developed markets, insurance companies are actually one of the biggest market cap companies, in the financial services space. And probably over a 10 years time, you will find some of these insurance names also to be not just in the frontline indices like Sensex and Nifty, but also become some of the largest market cap companies overall. So that's where some of the questions are from the registration side. I'm just looking at now some of the questions that people have put on the Q&A box, and I'll just ignore some of them which I've already answered, like HDFC better than iPru or anything of that sort. There's a question on Nippon Life. It's an AMC. I don't cover that. It's not an insurance company. There is a question on, one attendee asks that he has bought SBI Life at 990. It is now around 735. Should I try to average now or wait for results around July, August? Honestly, if you have a long-term view, stay hold with your investment. It is going to revert back to those levels and give you returns much more than that. If you have more appetite, then these are good times to invest in some of these insurance names, considering that the valuations are slightly, depressed. But all of that should be kept in mind from the perspective of long term, right? If you're looking at quick returns in the next 3 to 6 months, probably you won't get those kind of returns, primarily because some of these companies have already recovered from their lows. I'm just going to scroll through some of the other questions. Yeah, there is a question on PE for life insurance companies, asking that these seem very high and do you advise to buy at those valuations? Please note that price to earnings is not a good multiple to look at for life insurance companies, because the way their P&Ls work is that most of the acquisition cost of policies get expensed out in the P&L upfront, but you are basically selling a policy which will give you premiums over the next 10, 20, 30, 40 years. Right. So in that ways, the near term financials might look depressed, primarily because you have spent a lot in acquiring that business, but the fruits of that will be, will come through over the next 20, 30, 40 years. So don't look at it from price to earnings perspective. There are specialized valuation methodologies like price to embedded value, which is what you should look at, and that is one of the metrics that we look at when valuing some of these companies. There's a question from Mr. Shailesh Kanani. What's your view on the lower investment income or write-off for insurance companies due to COVID-19? So there are two aspects to it, right? So one is the investment income. So of course, yields, especially on long-term debt, has gone down. 10-year G-Secs are now at 6%. It used to be 7% plus 6 months ago. So reduction in yield is clearly going to have some impact on investment income from a slightly medium-term perspective. Do remember that they have an existing debt book, which would have significant capital gains as a result of yields falling. So I think in the near to medium term, things are okay. They can offset the lower yields with higher capital gains on the investment income side. From a write-off perspective, I think the insurance companies are still relatively better placed compared to some of the other companies or sectors, primarily because there are regulations in terms of how much you can invest where, right? So there are restrictions in terms of what you can invest in, how much you have to invest in central government securities, state government securities, debt, equity, and everything. And so from that perspective, the overall risk of write-off is probably low in case of insurance companies compared to some of the other sectors. Of course, there is always risk. Some of the things like ILNFS did hit some of these insurance companies. Investments in yes banks, tier one bonds, companies had to take write-off. So those kind of things happen, and I think it's part and parcel of overall debt investment strategy. But otherwise, the company's investment books are much better compared to some of the other sectors. Then if we look at, again, some similar questions on long term, whether one should buy with a 3-year perspective with stocks being at current levels, absolutely yes. If you're a long term investor, just, insurance is a good sector to own. There are questions on IT and pharma. I think probably this is not the right forum to answer those. There is a question on market share for Hdfc and IPRU. I think, these two probably would be, I don't have the numbers offhand, but, all of that is available on IRDA website. I think both of them on an AP basis probably would be close to about, somewhere around 10% odd. I don't remember the numbers right now. Will COVID claims not dent profits badly? As I mentioned, no. For general insurance, the claims will actually be lower. On health, the underpenetration levels are so low that unless we are looking at 10 million cases in India, the impact on health insurance will be fairly low for the private companies, and that's where that will not impact profitability. And again, on life insurance also, the real term protection penetration is so low, and unless we are looking like if we are staring at 1 million deaths in the fatalities in the country, probably it's just going to be a non-material impact on the insurance companies. Can we invest from mutual funds? Can we invest from sorry, I just lost that question. Let me just go back to the next one. Can we invest from mutual funds to insurance sector in the present situation? So the comparison between mutual fund and insurance, right? I think this is something which has been one of the most frequently asked questions, right? So there are both pros and cons in investing in a mutual fund versus, investing in an insurance sector, right? Mutual funds, even from a customer perspective, mutual funds give you flexibility of liquidity in the near term. You can sell whenever you want. There are hardly any lock-ins. Probably there is an exit load that you have to incur. So from that perspective, and the overall charges incurred in owning a mutual funds are lower. When you look at life insurance products, there is probably at least a 5-year lock-in, and that is something, and probably the charges are higher. But on the flip side, what you get as advantage is that you can allocate your assets between debt and equity and change that allocation as many number of times without having any tax or cost implications. And insurance, as I said, is still tax-free compared to investments in equity, which are not tax-free anymore. There is a question on Bajaj Life and Tata AIA. I mean, Bajaj Life, I had mentioned, it's part of Bajaj Finserv, and Bajaj Finserv, large part of the value comes from Bajaj Finance. So, not focusing on that stock. Tata AIA is not listed. So there is no view to give on that as such. Yes, so there is a question from Purvi R saying that there were news around a few months back that life insurance companies would be allowed to sell health products. Any update on that? Yes, so this is something which is still under consideration. There were recommendations issued around this. Life insurance companies today are not allowed to sell indemnity health products. There are significant restrictions in terms of what kind of health products life insurance companies can sell. And that is why, they're not big players on the health insurance segment. contrary to how it is in global markets, where life insurance companies are the biggest sellers of health insurance products also. Recently, there are recommendations that life insurance companies probably should also be allowed to do that. Still under consideration. Of course, there are arguments both in favor and against that. So we don't know, how or when IRDA will decide whether life insurance companies are going to be allowed to do this. But if you really look at it, if it happens, of course, it will reduce the opportunity set for general insurance companies which are selling health insurance. But on the flip side, it will increase penetration significantly, right? I mean, the kind of distribution structure that life insurance companies have is unparalleled. And that will ensure that the 8-9% health insurance penetration that we have in the country is going to increase far more rapidly. So I think from that perspective, it's probably better, but there are other challenges. And as a result, it's very difficult to know whether that will happen or not. So only time will tell. I think there are quite a lot of questions comparing some of these stocks, and I think I've already given some of them. There's a question on if government is going to extend the time of insurance due to COVID. I guess this is related to the payment terms on renewals or new policies. I think, till the time the lockdown is there, probably you'll see the government extending those timelines. But once lockdown gets over, I don't think that's going to happen anymore. The impact is just near term, some of the investment income loss that the insurance companies will face, but it is far lower than potentially loss, that the potential loss that they would have seen if there was, non-continuation or lapse of policies, right? Because they have spent so much to acquire a policy, and if that discontinues, then the loss is much bigger. So I think that is something which is fairly manageable. There's a question which is asking for a comparable of HDFC Life to, in the international markets. I think, for international companies, I think one of the, or maybe a couple of names which come close to the kind of business models that you have in India are AIA, which has operations in most of the Asian countries, China, Hong Kong, Malaysia, Singapore, Indonesia, apart from India, where they are in tie-up with Tata. So that is one company you can probably look at if you want to compare. And the other one is Prudential. Again, even though it's a European company, but has significant exposure in the Indian markets. Again, Prudential in India has tied up with ICICI, but it is present in China. It is present in some of the other Asian countries as well. So probably these two are the comparable companies. But do remember that India is significantly behind in terms of penetration. And as a result, scope for the industry to grow and to improve their profitability is far higher and for a far longer period. So don't compare valuations, do compare, in terms of where things could progress for, for these companies. Then I'm just looking at some of the other questions. What could be so there's a question on what could be the correct price to enter ICICI Lombard. I guess, as I said, if you're a long-term investor, whenever you see some correction, buy it. If you're near-term, probably wait for the stock to be at around 1150 or lower. Don't buy it at 1300. In the near term, you won't get returns on that. That's what our view on the stock is. There's a question from Mr. Shekhar: which probable players in life insurance and general insurance could potentially come up for IPO in the near term? So that's difficult to tell, right? So of course, government has shown intention to list LIC. They have shown intention to merge the 3 other PSUs in the general insurance sector, and then probably list them as well, or merge them with New India and have a big entity which is listed. So probably some of these PSUs will come to the market in the medium term. You'll probably see, some of the other bigger players which are not there, HDFC or Go, SBI General, some of these companies could also potentially come. We don't know whether, when they will come, or, some of these companies have made comments in media in the past suggesting their intention to come to the markets, but without giving any reasonable timeline. So let's wait and watch. Um, okay, so I think most of the questions have been answered. Um, okay, so there is an interesting question from Mr. Sunil Mali who asks, digital insurance companies like Acco and others claim that they do vehicle insurance at significantly lower costs in comparison to big names. Will this discounting strategy hurt big names? See, just like any other sector, if there is, startup company which has come with capital, one of the easier ways for them to gain any kind of market share is through pricing discounts. And we see that in every sector, right? I mean, you look at it, across sectors, that's the thing that you'll see on the B2C space. So I think, that is one of the strategies that these companies try and adopt to get the initial market share, and then through better consumer experience, probably build on that market share. So in the near term, till the time they have capital to burn, they'll probably discount, if at all they are at lower costs. Um, will it hurt big names? Probably not materially, primarily because it's a significantly underpenetrated industry, right? So from that perspective, I think it is not going to impact most of these large players as much. And probably I'll take one last question before wrapping up. Um, there's a question on, on the non-life sector, whether there is an effect on property insurance due to smaller industries getting impacted by COVID. Yes, so that's something which is definitely could happen, right? So as you know, the economy sees significant pressure, you will see MSMEs, probably some of them disappearing, probably some of them shutting down in the near term, and as a result, property and casualty insurance, more importantly, the fire insurance could get impacted. But remember, as I told you earlier, there is significant underpenetration in the industry. And even if in the near term there is some bit of impact, if from a 2, 3, 5, 10-year perspective, these companies will still continue to grow at a pretty decent rate. So I think from that perspective, I don't think one should be too much worried about that. Just to summarize, insurance remains one of the better industries to invest in from a longer term perspective, even for retail investors, and should be looked at in these times with definitely a long term horizon. If you have a near term, probably avoid it at this point of time and look for better entry points. So with that, I'll wrap up the webinar. Thank you for all the participants who have joined in. If you have any more questions or need more details, please write to us at research@ifl.com, or you can always visit us on www.ifl.com. And with that, I'll wrap it up. Thank you so much.